quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Most traders spend years trying to find the perfect strategy, the perfect indicator, or the perfect entry. But here is the uncomfortable truth. Professional traders are not thinking about any of that in the way you think they are. They are not obsessing over entries, they are not chasing signals, and they are certainly not relying on anything that feels like certainty. Instead, they operate from an entirely different mental framework. And until you understand that framework, you will always feel like you are close to consistency but never quite there. This is where most traders get it wrong. They believe success in trading comes from doing something better. In reality, it comes from thinking differently. The difference between a losing trader and a professional is not information, it is interpretation, decision-making, and emotional structure. In this video, you are going to learn how professional traders actually think. Not what they say publicly, not what gets simplified into social media content, but how they truly process information, risk, and uncertainty. By the end of this, you will start to see the market through a completely different lens. And more importantly, you will start to recognize why most retail behavior is structurally flawed from the beginning. Professional trading is not about predicting the market. That idea needs to be removed immediately. The moment a trader believes their role is to predict, they have already positioned themselves for failure. Professionals think in probabilities, not predictions. They do not ask what will happen, they ask what is most likely and what is the risk if I am wrong. That shift alone changes everything, because now the focus is no longer on being right, it is on managing outcomes, and this is critical. Retail traders tie their identity to being correct. Professionals detach completely from that. They understand that being wrong is part of the process, not a failure of it. This allows them to operate with consistency. Because they are not emotionally reacting to every outcome, they are executing a framework. Now this is important. Professionals are not guessing. They are building structured hypotheses based on data, macro context, sentiment, and risk conditions. But they fully accept that even a strong idea can fail. So instead of trying to eliminate losses, they control them. This is the foundation of professional thinking. It is not about certainty, it is about controlled uncertainty. Another fundamental shift in professional thinking is how they view the market itself. Retail traders tend to see the market as something to beat, something to outsmart, almost like an opponent. Professionals do not think like that at all. They see the market as an environment, and in any environment the goal is not to fight it, the goal is to adapt to it. Think about that carefully. If the market is trending, a professional is not asking whether the trend is justified, they are asking how to position within it. If the market is uncertain, they are not forcing trades, they are reducing exposure. This adaptive mindset is what creates longevity, because the market is constantly changing and rigid thinking leads to repeated losses. Most traders fail because they try to apply the same logic in every condition. Professionals understand that context is everything. They are constantly asking, what kind of market is this? And then they adjust their behavior accordingly. This is why two professional traders can look at the same market and make different decisions, yet both be correct, because the decision is not about being universally right, it is about being aligned with a specific framework within a specific environment. Now let's go deeper into how professionals actually make decisions. One of the biggest differences is that they do not rely on single factors. Retail traders often look for one reason to enter a trade. Maybe it is a pattern, an indicator, or a piece of news. Professionals build confluence. They stack multiple independent factors that point in the same direction. This might include macroeconomic conditions, interest rate expectations, positioning data, and broader risk sentiment. Each factor on its own is not enough, but when several align, the probability of the trade increases. This is how professionals create an edge, not through certainty, but through alignment. And this is where discipline becomes critical, because sometimes the factors do not align, and in those moments the professional does nothing. This is one of the hardest things for developing traders to accept. Doing nothing is a decision, and often it is the correct one. Professionals are not driven by the need to trade. They are driven by the need to protect capital and execute only when conditions justify it. This patience is not passive. It is active restraint based on a clear understanding of when opportunity actually exists. Finally, you need to understand how professionals think about risk, because this underpins everything else. For a retail trader, risk is often an afterthought. It is something considered after the trade idea is formed. For a professional, risk is the starting point. Before they even consider entering a trade, they are already asking, how much can I lose? And does this make sense relative to the potential outcome? This completely changes the decision-making process, because now a trade is not judged purely on its potential profit, but on its risk-adjusted value. This is where most traders get it wrong. They focus on how much they can make, not how much they can lose. Professionals reverse that. They accept that losses are inevitable, so they design their approach to ensure that losses are small and controlled, while gains have the potential to be larger over time. This creates asymmetry, and asymmetry is where profitability comes from. Not winning more often, but managing the relationship between wins and losses. Once you truly understand this, you stop chasing trades, you start evaluating them. And that is the moment your thinking begins to shift from amateur to professional. Now, this is critical. Professional traders think in terms of process, not outcomes. Most traders evaluate themselves based on whether a trade made money or lost money. Professionals do the opposite. They evaluate whether the decision was correct based on their framework, regardless of the outcome. This distinction is what creates long-term consistency. Because if you judge yourself purely on results, you will reinforce bad habits and punish good ones. A poor trade can make money, and a good trade can lose. Professionals understand this deeply. So instead of asking, did I win or lose? They ask, did I follow my process? If the answer is yes, then the outcome is irrelevant in isolation. Over time, a strong process produces positive results. But in the short term, randomness exists. And this is where most traders break down. They abandon a good approach after a few losses, or they double down on a bad one after a few wins. Professionals avoid this trap by anchoring themselves to process. This allows them to remain stable in an unstable environment. And stability in decision-making is one of the most valuable edges a trader can have. Let's build on this by understanding how professionals define an edge. Retail traders often think of an edge as a specific setup or strategy, something they can point to and say this works. But professionals define an edge much more broadly. An edge is not a single thing, it is a combination of factors that, when executed consistently, produce a positive expectancy over time. This includes their strategy, their risk management, their execution discipline, and their psychological control. Remove any one of these and the edge breaks down. This is why copying a strategy rarely works, because the strategy is only one component of a much larger system. Professionals know that their edge is fragile. It requires maintenance, refinement, and strict adherence. They are constantly reviewing their performance, not to chase perfection, but to ensure alignment. And importantly, they understand that edges evolve. What works in one market condition may not work in another, so they remain flexible. They adapt their approach without abandoning their core principles. This balance between structure and adaptability is what allows professionals to survive and thrive across different market environments. Another key element of professional thinking is how they handle uncertainty. Most traders are uncomfortable with not knowing. They want clarity, confirmation, and certainty before acting, but the market does not provide that. In fact, the more certain something feels, the more likely it is that risk is being underestimated. Professionals accept uncertainty as a permanent condition. They do not try to eliminate it. They build systems that function within it. This is a subtle but powerful shift, because instead of waiting for perfect conditions, they define acceptable conditions. They know that every trade carries uncertainty, so they focus on managing exposure rather than eliminating doubt. This is why professionals can act decisively even when the outcome is unclear. They are not paralyzed by uncertainty because they have already accounted for it. This is where confidence actually comes from in trading. Not from knowing what will happen, but from knowing how you will respond if you are wrong. Once that is clear, hesitation disappears and execution becomes consistent. Now consider how professionals think about time. Retail traders are often focused on immediate results. They look at trades in isolation, judging success or failure within hours or days. Professionals operate on a much broader time horizon. They think in terms of sequences, not individual outcomes. A single trade means very little to them. What matters is the distribution of outcomes over many trades. This long-term perspective changes behavior significantly, because when you think in sequences, you no longer feel the need to make every trade work. You simply need to execute consistently over time. This reduces emotional pressure and improves decision quality. It also reinforces discipline, because shortcuts and impulsive decisions might produce short-term gains, but they damage long-term performance. Professionals are always aware of this trade-off. They prioritize sustainability over immediacy, and this is why they can remain calm during losing streaks. They understand that losses are part of the distribution, not a signal to abandon their approach. This level of perspective is what separates emotional trading from professional execution. Finally, let's address how professionals think about control. This is where many traders struggle without even realizing it. Retail traders often try to control the market. They look for ways to increase certainty, refine entries, and avoid losses entirely. Professionals understand that the market cannot be controlled. The only thing that can be controlled is their own behavior. This includes their risk, their execution, and their discipline. Once this is fully accepted, trading becomes much simpler, because instead of reacting to every market movement, professionals focus on maintaining consistency in their actions. They define their rules and they follow them, not because they are guaranteed to work every time, but because over time they produce an edge. This shift from external control to internal control is one of the most important transitions in trading. It removes frustration, reduces emotional volatility, and creates a stable foundation for decision making. And ultimately, this is what professional thinking is built on, not trying to master the market, but mastering oneself within it. Now, this is where professional thinking becomes even more refined. Professionals think in terms of opportunity cost. Most traders only focus on the trade in front of them. They ask, should I take this trade? But professionals expand that question. They ask, is this the best use of my capital right now? That is a completely different level of thinking, because capital is finite, and every trade you take means you are not taking another. So instead of evaluating trades in isolation, professionals compare them. They prioritize the highest quality opportunities and ignore the rest. This is why they trade less but perform better. They are not trying to capture every move. They are selectively engaging with the market when conditions offer the strongest alignment. This is a difficult mindset to develop because it requires patience and restraint. It also requires confidence in your ability to wait, but once you adopt this approach, your trading becomes far more efficient. You are no longer reacting, you are choosing, and that choice is based on quality, not frequency. Another defining characteristic of professional traders is how they think about losses. Retail traders see losses as something to avoid. Professionals see losses as a business expense. That distinction matters because when something is treated as an expense, it becomes planned, controlled, and accepted. Professionals expect to lose on a percentage of their trades. They build that into their system. This removes the emotional shock that most traders experience when a trade fails. Instead of reacting impulsively, they simply move to the next execution within their framework. Now, this is important. Accepting losses does not mean being careless. It means being precise about how much you're willing to lose and under what conditions. Professionals define this before entering a trade. Once the trade is active, there is no negotiation. This discipline is what prevents small losses from becoming large ones. And over time, this is one of the biggest differences between profitability and failure. Not the size of the wins, but the control of the losses. Let's now focus on how professionals think about information. In today's environment, there is an overwhelming amount of data, news, opinions, and analysis. Most traders try to consume as much as possible, believing that more information leads to better decisions. Professionals take the opposite approach. They filter aggressively. They focus only on information that is relevant to their framework. Everything else is noise. This is a critical skill because too much information leads to confusion, hesitation, and inconsistency. Professionals define what matters in advance. For example, they may focus on macroeconomic trends, central bank policy, and risk sentiment. When new information comes in, they do not react immediately. They interpret it through their existing framework. This prevents emotional decision-making and maintains consistency. It also allows them to act quickly when necessary because they are not overwhelmed. They have already defined what is important. This clarity is what gives professionals their decisiveness, not because they know everything, but because they know what to ignore. Now consider how professionals think about execution. This is where discipline is tested in real time. Many traders understand what they should do but fail to do it consistently. Professionals remove as much discretion as possible from execution. They define their rules clearly and they follow them without hesitation. This does not mean they are rigid. It means they are structured. They know exactly what conditions justify a trade, how much risk to take, and how to manage the position. Once those conditions are met, execution becomes almost automatic. This reduces emotional interference and improves consistency. Now, this is key. Professionals do not rely on motivation or willpower. They rely on systems, because willpower is unreliable, especially under stress. Systems, on the other hand, create repeatable behavior, and repeatable behavior is what produces consistent results. This is why professional trading often looks simple from the outside, because the complexity has already been handled in the preparation. What remains is disciplined execution. Finally, let's explore how professionals think about improvement. Most traders look for breakthroughs. They want a single insight or strategy that will transform their results. Professionals do not think like that. They focus on incremental improvement. Small refinements, applied consistently over time, lead to significant progress. This might involve reviewing trades, identifying patterns in mistakes, or refining risk parameters. Each adjustment is small, but over time they compound. This approach also creates stability, because instead of constantly changing direction, professionals evolve their existing framework. They build on what works and eliminate what does not. This continuous feedback loop is what drives long-term success, and importantly, it keeps them grounded. They are not chasing perfection, they are pursuing consistency. And consistency in trading is far more valuable than occasional brilliance. Once you adopt this mindset, your focus shifts from trying to be exceptional in a single moment to being reliable over time, and that is exactly how professionals think. Now, this is where professional thinking becomes even more strategic. Professionals think in terms of scenarios, not single outcomes. Most traders build one idea and attach themselves to it. They decide the market is going up or down, and then everything they see reinforces that belief. Professionals do the opposite. They define multiple possible scenarios before entering a trade. They might identify a primary scenario, a secondary scenario, and an invalidation point. This creates flexibility because when the market evolves, they are not surprised. They have already considered alternative paths. This reduces emotional reaction and allows for controlled adaptation. Now, this is critical. Professionals are not constantly changing their bias. They are structured in how they adjust. Each scenario has predefined conditions. If those conditions are met, the response is already planned. This is what gives professionals composure under pressure. They are not reacting in real time without preparation. They are executing predefined responses to evolving conditions. And this level of preparation is what separates reactive trading from professional decision making. Let's now focus on how professionals think about consistency. Most traders believe consistency comes from winning trades regularly. That is not how professionals define it. For them, consistency comes from consistent behavior. If your process is consistent, your results will stabilize over time. But if your behavior is inconsistent, your results will always be volatile. This is why professionals prioritize routine. They approach trading in the same structured way every day. They analyze the market using the same framework. They assess risk using the same criteria, and they execute using the same rules. This repetition creates stability. It removes randomness from decision making and allows performance to be measured accurately. Because if your process changes constantly, you cannot evaluate what is working. Professionals eliminate this problem by standardizing their behavior. This is not about being rigid, it is about being reliable, and reliability is what allows for long-term improvement. Because once your behavior is stable, you can refine it with precision. Another key element of professional thinking is how they manage emotions. It is often said that traders need to remove emotion entirely. That is not realistic. Professionals still experience emotion. The difference is that they do not allow emotion to dictate decisions. They create structures that limit emotional impact. This includes predefined risk, clear rules, and disciplined execution. When these are in place, emotions become less disruptive. Now, this is important. Professionals do not try to feel nothing. They focus on acting correctly despite what they feel. This is a crucial distinction, because waiting for the perfect emotional state is unrealistic. Instead, professionals build the ability to execute under imperfect conditions. This is where experience plays a role. Over time, repeated exposure to the same situations reduces emotional intensity. What once felt stressful becomes normal, and as that happens, decision making becomes clearer. This is why consistency is so powerful. It does not just improve results, it stabilizes your internal state, which further improves execution. Now let's examine how professionals think about capital. Retail traders often see capital as something to grow as quickly as possible. Professionals see it as something to protect above all else. This shift in priority changes everything. Because if capital is protected, opportunities will always exist in the future. But if capital is lost, the ability to participate disappears. Professionals understand this deeply. They do not take unnecessary risks, and they do not expose themselves to situations where a single decision can cause significant damage. This is why position sizing is so important in professional trading. It ensures that no single trade can have a disproportionate impact on overall performance. Now, this is where most traders get it wrong. They increase risk after losses, trying to recover quickly. Professionals do the opposite. They maintain consistency in risk, regardless of recent outcomes. This prevents emotional escalation and keeps performance stable. Over time, this disciplined approach to capital is what allows for sustainable growth. Finally, let's bring this together by understanding how professionals think about the long game. Trading is not about short-term success. It is about long-term survival and growth. Professionals measure their progress over months and years, not days or weeks. This perspective removes the pressure to perform immediately. It allows for patience, discipline, and continuous improvement. Now, this is critical. When you adopt a long-term mindset, your decisions change. You stop chasing trades, you stop reacting emotionally, and you start thinking strategically. Every decision is made with the future in mind. This creates alignment between your actions and your goals. And over time, that alignment produces results. Most traders never reach this point because they are focused on immediate outcomes. But once you shift your perspective, everything becomes clearer. Trading is no longer a series of isolated decisions. It becomes a structured process of growth. And that is exactly how professionals think. Now we move into a deeper layer of professional thinking. How institutions and experienced traders actually frame decision making at a higher level. Professionals do not simply ask whether a trade is good or bad. They think in terms of distribution and positioning within the broader market structure. They are constantly asking, where is the majority positioned and where is the imbalance? Because markets move not just on information, but on positioning shifts. This is where most traders lack depth. They focus on price movement without understanding the underlying flows driving it. Professionals are always aware of who is likely on the wrong side of the market and what could force them to exit. This creates opportunity because when positioning becomes crowded, even a small shift in expectations can trigger significant movement. Now, this is critical. Professionals are not guessing where everyone is positioned. They are using data, sentiment, and macro context to build a picture. And once that picture is clear, they are looking for asymmetry, situations where the downside is limited, but the upside could be significant if positioning unwinds. Another institutional level concept is how professionals think about narrative. Markets are driven by narratives, stories that participants collectively believe about the future. These narratives might revolve around inflation, central bank policy, growth expectations, or risk conditions. Professionals do not blindly follow these narratives, but they do respect their influence. They are constantly asking, what is the dominant narrative and is it changing? Because when a narrative shifts, it can lead to sustained moves in the market. This is where timing becomes important. Entering too early before the narrative gains traction can lead to frustration. Entering too late after the move is extended increases risk. Professionals aim to position themselves during the transition phase when a narrative is forming but not yet fully priced in. This requires patience and awareness. It also requires the ability to detach from consensus when necessary, because sometimes the best opportunities arise when the prevailing narrative begins to break down, and recognizing that shift is a key part of professional thinking. Now let's examine how professionals think about conviction. Conviction is often misunderstood. Retail traders associate conviction with confidence. They believe that if they feel strongly about a trade, they should increase their size. Professionals do not operate like that. Their conviction is not emotional, it is structural. It is based on the alignment of multiple factors within their framework. When those factors align strongly, conviction increases. But even then, risk remains controlled. This is a crucial point. High conviction does not mean abandoning discipline. It means allocating capital within predefined limits based on the quality of the setup. Professionals understand that even the best ideas can fail, so conviction influences positioning, but it never overrides risk management. This is what keeps their approach stable. Because they are not swinging between extremes, they are adjusting exposure within a controlled system. And over time, this leads to more efficient use of capital and more consistent performance. Let's now go deeper into how professionals think about drawdowns. Every trader experiences periods of loss. The difference is how those periods are managed. Retail traders often respond emotionally, either by increasing risk to recover losses quickly or by becoming overly cautious and missing opportunities. Professionals have a predefined approach to drawdowns. They understand that losses come in clusters and they plan for that. This might involve reducing position size after a series of losses or temporarily stepping back to reassess conditions. The key is that the response is structured, not emotional. Now, this is important. Professionals do not panic during drawdowns. They analyze them. They ask whether the losses are due to normal variance or a breakdown in their process. If the process is still valid, they continue. If not, they adapt. This ability to remain objective during difficult periods is one of the defining traits of professional traders, because it prevents short-term setbacks from turning into long-term damage. Finally, let's explore how professionals think about sustainability. This is something that is rarely discussed, but it is essential. Professional trading is not about intense bursts of performance followed by burnout. It is about maintaining a high level of performance over time. This requires balance. Professionals understand that decision-making quality is directly linked to mental and physical state. Fatigue, stress, and overexposure to the market all degrade performance. So they manage their environment carefully. They take breaks, they limit unnecessary exposure, and they maintain routines that support clarity and focus. Now, this is critical. Sustainability is not separate from performance. It is part of it. Because a trader who cannot maintain consistency over time will eventually fail, regardless of short-term success. Professionals recognize this early. They build systems, not just for trading, but for themselves. And this is what allows them to operate at a high level, not just occasionally, but consistently over the long term. Now we move into practical application, because understanding how professionals think is only valuable if it changes how you operate. So let's break down how a professional would approach a trading decision from start to finish. The first step is always context. Before any trade is even considered, a professional is asking, what is the current environment? Is the market trending, ranging, or uncertain? What are the dominant macro drivers? What is the broader risk sentiment? This initial framing determines whether there is even a reason to be active. Most traders skip this step entirely and go straight to looking for entries. Professionals do the opposite. They filter first, and only then do they look for opportunity. If the environment does not support clear decision making, they simply do not engage. This is where discipline begins, not in execution, but in selection, because the quality of your decisions is heavily influenced by the conditions in which you make them. Once the environment is clear, the next step is building a structured idea. This is not a random opinion or a reaction to price movement. It is a defined hypothesis. A professional might think, given the current macro conditions and sentiment, this market has a higher probability of moving in a specific direction, but this is immediately followed by defining the conditions that support that idea as well as the conditions that invalidate it. This is critical because now the trade is not just an entry, It is a complete framework. It includes the reasoning, the risk, and the exit conditions. This removes ambiguity. When the trade is active, there is no need to second guess or reinterpret the situation emotionally. Everything has already been decided in advance. This is what allows professionals to execute with clarity. They are not figuring things out in real time. They are following a predefined plan based on structured thinking. Execution then becomes a simple extension of preparation, and this is where most traders expect something complex. But in reality, professional execution is often very straightforward. Once the conditions are met, the trade is placed according to predefined rules, risk is allocated consistently, and the position is managed according to the original plan. Now, this is important. Professionals do not constantly interfere with their trades. They do not adjust stops impulsively, and they do not exit positions based on short-term noise. They allow the trade to play out within the parameters they have already defined. This requires trust in the process, and that trust is built through repetition and experience. Because once you see that disciplined execution produces stable results over time, the need to interfere disappears. This is where trading becomes more controlled, more consistent, and far less stressful. As we begin to bring this together, it is important to recognize that professional thinking is not something that appears overnight. It is developed through deliberate practice and continuous refinement. Every concept covered in this video, from probability thinking to risk management to process-driven execution, must be applied consistently to become effective. This is where most traders fall short. They understand the ideas, but they do not implement them with discipline. Professionals bridge that gap. They do not just know what to do, they do it repeatedly even when it is difficult. And over time, this creates a compounding effect. Small improvements in thinking lead to better decisions. Better decisions lead to more stable results, and those results reinforce the process. This is how progression actually happens in trading, not through sudden breakthroughs, but through consistent application of sound principles. Ultimately, how professional traders think comes down to one core idea: control what can be controlled and accept what cannot. They do not try to predict the market with certainty. They do not chase outcomes, and they do not rely on emotion. They operate within structured frameworks. They manage risk with precision, and they execute with discipline. This is what creates consistency, and consistency is what defines a professional. If there is one thing to take away from this entire video, it is this: success in trading is not about finding something others have not discovered. It is about thinking in a way that most people are not willing to adopt. It requires patience, discipline, and a commitment to process over outcome. But once that shift happens, everything changes. The market becomes clearer, decisions become easier, and performance becomes more stable. And that is what it truly takes to think like a professional trader.